Hey, it's Mike over at Cross Country Mortgage, and it's Monday morning. It's time for your Monday morning mortgage update for the week of October the 21st. I hope you all had a great weekend. Gail and I had a fantastic weekend. Felt like a weekend. Got a lot of stuff done and had a lot of great experiences. So let me share a couple pictures with you. We hiked to the top of Castle Craigs. If you've never been up there, it is stunning. And we timed it so that the wind blew a lot of the smoke out. We had amazing views, great hike. This is looking north at Mount Shasta through the dome at the top. Again, just a tremendous hike. If you've never done it before, take plenty of water, plan for about a 6 to 8 mile round trip and about 2,500 feet of climbing, but well worth it. So let's talk about what happens in the market last week and this week. I always try to give you insight about what's going on, what's affecting mortgage rates, what's affecting really the real estate market in some degree. So last week we saw rates get worse. We saw pricing, the cost of that rate. We look at two things. We look at the rate itself and how much that rate's going to cost. And the pricing got worse by about 16 basis points. Not a big shift, but now if we look at the last 3 weeks, we've seen pricing get worse by over 1.5 basis points, over 1.5%. Let's see, last week, 32, negative 32. The week before that, negative 83. And then it opened up today, negative 40. So big pressure on the market, big pressure on mortgage rates. So put that in perspective. If I quoted you an interest rate at 7% 3 weeks ago, today, that same rate would cost you 1.5% or 1.5% discount point. That's basically 1% or a percentage of the loan amount. So you can take that same rate, or you can just get a higher interest rate, which is what typically what lenders do, is they'll quote you a higher interest rate so you're not paying a bunch of discount points. So bottom line is rates and or pricing both got worse in the last 3 weeks. So what are we looking at this week? Pressure. That really is the word of the week. Right now is a lot of pressure on mortgage rates. I always try to give you some stuff that's going to really move the market. 3 things: Federal Reserve members speaking this week, giving their insight about what's happening in the market. The Treasury, the Fed selling debt, raising money. They always do this every month. And then Middle East and oil. How's that affecting the market? So let's talk about Fed speak. So the next Fed meeting is in 2 weeks. Week and a half. It'll start on the 5th, end on the 6th on a Wednesday. And so this is the last week they have to give their insight about what they think's happening in the market, influence what's going to happen at that Fed meeting when the Fed either raises, cuts rates, or leave them alone. And boy, we've all been paying a lot of attention to that because what the Fed does impacts the market. So this week, again, the last week, because next week's called a media blackout. They can't say anything leading into that Fed meeting. And really the Feds are going to give their insight on whether the Fed's going to cut rates in a week and a half. And let's put this in perspective. 30 plus days ago, 60 days ago, everybody knew that the Fed was probably going to cut rates 0.5% in November, 0.25%. Now, with all the pressure that's been on the market over the last 3 weeks, now there's discussion that maybe we'll see no Fed rate cut up to 0.5 point. So bond traders, which is where mortgage-backed securities are traded, hate uncertainty. They don't want to know what's going to happen long term. And so because of all this uncertainty and the things we're going to talk about, Middle East and selling debt and all that stuff, and fake jobs numbers, we've seen those jobs numbers come out that nobody believes, but it's the data that the Fed uses to make decisions, that they're pulling money out of the bond market. And when money flows out of that bond market, let's look at a chart here. That's when we see rates go up. So this is the trading of mortgage-backed securities, a representation of it. I show you this all the time. It's a live feed, and this is over a year. And I want to show you some interesting perspectives here. So if we look today on the right-hand side, you can see that big red candlestick. That means money took off out of the bond market, and you can see this little feed up in the right-hand corner. It's a live feed, and this shows the 10-year Treasury. But look at 49 basis points negative. Money's flowed out of that bond market today. We've already seen 2 rate adjustments today where rates have gotten worse this morning. And so obviously this is the end of February and we're seeing not a great market. There's been a lot of pressure since the middle of September. You can see the market has just gone down, right? But I want to put this in perspective for you by showing you really what's been happening in February, in October. So obviously we see the market go down. Look at what happened last October. We saw the market go down, okay? And the October before that, this shows the end of October, that was in 2022. The market is down, but look what happened afterwards. In November, we saw the market actually improve into December. Look what happened in 2023. The market improved after that October sell-off. Somebody once told me that history doesn't repeat itself, but it sure does rhyme. So there are some indications here that we're going to see. I'm trying to get my drawing stick to work here. Market improvement. So there is some indication that we might see this recovery in the next couple months. Obviously, there's a lot of data that has to support that. But again, if we look historically, there's some precedent that we might see rates actually improve moving into the end of the year. So we're going to be paying a lot of attention to what those Fed members say this week. Are they going to give some indication that the Fed's going to cut rates or not cut them at all? And so we'll be paying a lot of attention to that. The next thing is selling debt. Treasury Department sells debt every single month. They have to raise money. They have to pay their debt. And there's a rare auction this week, the 20-year auction. So why is that relevant to mortgage rates? Because it's a long-term Treasury. 30-year Treasury, 20-year Treasuries. They also sell short-term bonds, 5, 7, 10-year bonds. So if there's an appetite for people to buy this 20-year Treasury, again, it's long-term, it mimics mortgage-backed securities, then that is going to be good for rates. But there's a lot of pressure. Do people want to stick their money in this volatile market right now, especially in the bond market? And so we'll pay attention to that 20-year Treasury auction to see if money flows in. If money flows in, that's good for rates. If money doesn't come, if there's no appetite to buy this U.S. debt, then it's going to be pressure on rates. And then the final thing is Middle East and the oil. So everybody's waiting for Israel to attack or do what they're going to do. Are they going to go after oil refineries? They said they're not going to. But all this puts pressure on oil prices. And we're starting to see oil prices go up. They've been so volatile over the last 3 weeks. And oil means higher prices for everything else because oil's in everything. And that's inflationary. And that puts pressure on rates for rates to go up. So if we see something happen this week, then we're probably going to see oil prices spike, and that could be pressure on rates. So again, the word is pressure. And what is pressure? Why is pressure good? Well, pressure is good because when people feel pressure, they do one of three things. They freeze, they quit, or they act. And a majority, if you look statistically, when people are under pressure, they typically freeze or quit. They want to wait maybe till something is going to happen, hoping something is going to get better, or they just get out and they just decide not to do anything. And this is for every industry. What you can do is realize you can't control the market, you can't control home prices, you can't control interest rates, and to act, to take advantage of these opportunities when pressure is there, because a majority of people will take the easy route. And you know the term, the road less traveled, obviously is one that pays off. So control your mindset, turn the media stuff off, control your efforts and control your activity, and use this pressure as an opportunity. Use this pressure as a way to take advantage of the opportunities that present themselves. Have a great, great productive week. We'll talk to you next week. Bye-bye.